I think we're ready to get started. So once again, good morning and welcome to today's webcast. My name is Anu Sood and I am the Director of Marketing at CaseWhere RCM. Now in today's webinar, we'll be talking about how to enhance your implementation of the beneficial ownership requirement of FinCEN's Customer Due Diligence Rule. Now, before we get started, I'd like to first thank Refinitiv for supporting this event. Quickly introduce CaseWhere RCM and Alessa. CaseWhere RCM is a division of CaseWhere International and is exclusively focused on building great software to fight financial crimes. Alessa is CaseWhere's recently rebranded product for AML compliance and fraud detection and prevention. It provides all the anti-money laundering capabilities that banks, MSBs, fintechs, casinos, and other regulated industries need, all within one platform. So the capabilities of the product include real-time due diligence, including identity verification, transaction monitoring and screening, sanction screening using third-party lists like those offered by Refinitiv, automated regulatory reporting, advanced analytics like anomaly detection, machine learning, and AI, and finally, dashboards to track the performance of your programs, workflows to provide step-by-step guidance to ensure compliance, and case management that tracks every step of your investigations so that you have a full audit trail, which is what is needed for full compliance. Now, if you'd like to know anything about our solution, feel free to email us at alessa@casewhere.com. So without further ado, I would like to introduce you to our speaker. Laura Kelly has a 35-year career spanning the fields of accounting, finance, risk management, and regulatory compliance. Most recently, from 2006 to 2018, she serves as the Director of Compliance for CoBank ACB, a $130 billion farm credit system institution, where she developed and managed the bank's anti-money laundering, fraud, and economic sanctions compliance programs. She holds a certified anti-money laundering specialist designation, as well as the CAM's audit specialization. She helped found the ACAM's Colorado chapter, serving as its executive board chair from 2016 to 2018, and programs director from 2015 to 2016. I'm very excited to work with Lori, and I hope you enjoy her presentation.
Okay, well, welcome everyone to this first of a two-part series, actually, where we'll be discussing ways to enhance your implementation of the FinCEN Customer Due Diligence Rule, or as we'll refer to it today, the CDD Rule. In today's presentation, we're going to cover a brief overview and refresher on the CDD Rule, the ins and outs of identifying beneficial owners, challenges and solutions for collecting beneficial ownership information, and rules and processes around identity verification for beneficial owners. The CDD final rule was published on May 11, 2016, after several years of debate, comment, and revision. It represented the most significant change to AML regulations in the U.S. since the USA Patriot Act in October of 2001. And it's also been one of the lengthiest to implement, over 4 years in the making, and with a generous 2-year implementation period, which closed on May 11th, 2018. It all started back in March of 2012 when FinCEN issued an advanced notice of proposed rulemaking. There was an enormous amount of commentary and concern from the financial services industry about this, in particular, about the requirements for financial institutions to identify beneficial owners of legal entity customers. The Treasury Department then held 5 public hearings around the country from July to December of 2012. The feedback from these discussions was what really helped shape the notice of proposed rulemaking, which was issued almost 2 years later on August 4th of 2014. The comments received from this and PRM were even more extensive than the advance notice. Banks and other financial institutions expressed really quite realistic concerns over these beneficial ownership requirements, citing them as burdensome and lacking in value, as corporate ownership information is, for the most part, completely unverifiable. So everyone waited anxiously for the final rule, which took nearly 21 months for FinCEN to publish. Something that I find quite fascinating about the CDD rule is that it effectively represents the government making an end run, if you will, around the states who don't and continue to refuse to collect critical beneficial ownership information during corporate formations. Numerous pieces of legislation have been brought forward at the federal level over the years, trying to put this type of requirement on the states, but these have all failed. And not surprisingly, because anonymous corporate formation is big business for many states, such as Delaware, Wyoming, and Nevada. The other interesting aspect of the CDD rule is that its release was well timed to coincide with the Financial Actions Task Force, or FATF's, 2016 mutual evaluation of the United States AML regulations. The U.S. received its lowest rating for lack of effort to prevent criminals from using legal entities or companies to hide and move money or carry out their illicit schemes. Before we identify beneficial owners, though, we first have to determine whether the legal entity customer is a type for which this information must actually be collected. There are 4 basic types of legal entities included under the requirement, and a much longer list of exemptions, which you'll see in just a moment. Corporations, or as we call them, C Corps, and LLCs, or limited liability corporations, these are pretty easy and straightforward, as are partnerships, which would also encompass limited liability partnerships. It's this other entity category that's more of a gray area. Now, with respect to this other entity created by filing a public document with the Secretary of State, I think this is a catch-all meant to include some of the more unusual entity types only seen in certain states. For example, Massachusetts and Washington State have something called a business trust, which is a trust, but it's treated as a corporation for tax purposes. These are also sometimes known as statutory trusts, common law trusts, or just Massachusetts trusts. And these are typically not registered with the Secretary of State. Also, there are 17 states and Puerto Rico that have something called a series LLC, which allows you to create separate sub-entities called series within a single LLC, and the liabilities of each series are only enforceable against that series. These as well are not registered with the Secretary of State. Now let's take a look at the exemptions. Do you see a pattern with many of these? Many of them are types of legal entities that already have extensive government oversight. Law enforcement could fairly easily obtain beneficial ownership information for these entities if they needed to get it. Now, sole proprietorships are excluded because the individual and the business are one and the same. Private trusts, meaning living trusts, revocable and irrevocable trusts, charitable trusts, etc., these exist solely to hold assets for the benefit of one or more beneficiaries. So a trust has no owners per se, therefore it's excluded. The last item in the exemptions, a foreign financial institution established in a jurisdiction where its regulator maintains beneficial ownership information, has created quite a bit of a headache for banks that have extensive dealings with foreign banks, especially in the import and export letters of credit world. So how do you find out whether a particular country's banking regulator collects beneficial ownership information for its institutions? Well, FinCEN has stated that it will not publish any such list of countries. So essentially you're on your own in figuring this out, which can be accomplished, but that is outside the scope of our presentation today. So you have a new commercial customer or a pre-CDD rule existing commercial customer that's opening a new account. How will you determine whether this customer's legal entity type falls under the inclusions or the exemptions? Obviously, in many cases, it's going to be pretty clear and straightforward. An LLC, a partnership, a publicly traded company, or a sole proprietorship are easy to identify and classify. But what about all the other types, especially when you get into government and quasi-government entities and other unique types of formations? And what about foreign companies? Well, as I see it, there are two particular approaches to this challenge. One, the financial institution can do it. This is the least onerous for the customer, but it's the most complex for the financial institution. It works well if your commercial customer base is mostly LLCs, corporations, and partnerships because these are easy to identify. However, this approach does introduce a certain level of compliance risk, meaning that a customer could be incorrectly excluded and beneficial ownership information not collected when it should have. The second approach is to have the customer self-identify their legal entity type. This is the approach we took at my bank. The big advantages to this approach are that, one, it eliminates the risk of incorrect exclusion, and it simplifies the logistics of requesting beneficial ownership information. We'll actually come back to this topic in more detail later in the presentation. But the bottom line is that your institution's policies, its risk appetite, and its customer base should dictate which approach, or perhaps a combination of these two, is most appropriate. The CDD rule categorizes individuals associated with a legal entity into two types, or as they call it, prongs. First, we have the ownership prong, which means any person, a human, who directly or indirectly controls 25% or more of the entity's equity interests. Now, this might be no one, or it could be up to 4 individuals. The control prong is one person with significant responsibility to control, manage, or direct the affairs of the entity. Now, it's important to note that the customer must always name someone under the control prong, even if they have no one under the ownership prong. And as well, the person identified under the control prong can certainly be the same as someone who's identified under the ownership prong. So let's look at some additional considerations here. First of all, what if one or more of the 25% or greater beneficial owners is a trust? Now, this is very common in family-owned businesses where there are lots of assets involved. In this case, the beneficial owner is the person who is the trustee of the trust. If the trustee is not an individual, human, you need to keep peeling back the layers until you get to a human. In other words, if the trustee is a company, any human owner of 25% or more of that company becomes the beneficial owner. And sometimes you'll see trusts where there are 2 trustees or co-trustees. And if that's the case, then only one of them needs to be identified. Now, another question that has come up quite a bit after implementation is the 25% threshold. Is this mandatory? Well, yes, at a minimum. But financial institutions are more than welcome to go lower based on risk. For example, a bank might want to identify beneficial owners of 15% or more, for example, when the legal entity customer is, say, a foreign company. You just can't go any higher than 25%. And while we're on the topic of the 25% threshold, you'll also have to decide whether you're going to round up or not. I've actually heard many law enforcement professionals predict that we're going to see a significant increase in ownership percentages just below the 25% threshold in order to avoid the beneficial ownership identification requirements. So if a person owns, say, 24.5%, will you round up to 25%? That's up to your institution to decide, and it is entirely within your discretion to do so. Along these lines, something else to keep in mind is that with the significant reduction in U.S. tax rates for corporations that went into effect at the end of 2017, we should expect to see a pretty dramatic increase in the number of legal entity formations and conversions from sole proprietorships and partnerships to C Corps S Corps or LLCs in the coming years. To identify who the humans are who actually own or control, either directly or indirectly, 25% or more of a legal entity, there can be some math involved. As I mentioned earlier, you often have to keep peeling back the layers to get to the human beings who are really in control. Now, this layering process is done entirely by design, either to shield the ultimate human owners from liability, or maybe it's to hide their true identities. Let's look at this simple example we have here with NewCo LLC. NewCo is directly owned by two legal entities, ABC and 123. ABC is owned by three people, Peter, Paul, and Mary, in varying proportions. Peter and Paul, 123, but not in equal proportions. So what's the easiest way to determine which of these people, if any, are 25% or more beneficial owners of NewCo? Well, let's look at the next slide to figure this out. Okay, so the easiest way I've found to calculate beneficial ownership is to assume that the legal entity customer's assets total $1. And if the company were to be liquidated, how much would each person get? This diagram illustrates what this would look like for NewCo. So Peter has a share in both the holding companies of NewCo. He would get 7 cents from ABC and 45.5 cents from 123. This adds up to 52.5 cents, making him a beneficial owner of NewCo at 52.5%. Paul is in a similar situation. His holdings from the two companies would get him a total of 30 cents, meaning he indirectly owns 30% of NewCo and is also a beneficial owner. Mary, on the other hand, only owns a percentage of ABC. Her share of the liquidation would only be 17.5 cents. So at 17.5% indirect ownership, she doesn't qualify as a beneficial owner of NewCo. Now, at times it can be very tempting to help a commercial customer by identifying for them who their beneficial owners are, especially when the customer is a simple LLC or a partnership that the institution is either already familiar with, or say you have the customer's formation documents in hand and can see who the owners are. However, this is a very slippery slope for several reasons. It certainly isn't the intention of FinCEN, meaning this is meant to be a declaration and an attestation by the client. It's risky for the institution to do so because things change often frequently, and especially with closely held corporations. And ownership data isn't collected by most states, as we've all agreed, so you can't get it from public sources either. But what about the growing number of vendor software solutions designed to identify beneficial owners for you? Now, in my personal opinion, is that you should use caution and request a live demo before purchasing this type of system. This is because these vendors are very likely getting their information from the same places you would yourself. In my past experience, these tools are very good when dealing with publicly traded companies because that information is published. But anything other than that tends to be lacking. This is because, again, the states simply don't collect, in many cases, direct ownership data, let alone beneficial ownership, when the direct owners of an entity are legal entities. In other words, when we have complex, multi-tiered ownership structures. So by now, every institution subject to the CDD rule has some type of data collection mechanism for beneficial ownership. Many institutions copied the sample form provided in the rule, but just as a refresher, the basic information that we must collect for each beneficial owner under both the prongs, ownership and control, are each person's full name, date of birth, tax ID number, and residence address. There is an attestation that needs to be completed as well, which is the name and signature of the person who's opening the account on behalf of the legal entity customer. There's also additional information which I think should be included on the form or as an attachment to it if you're making your own form, which will help with your confirming accuracy and it'll also provide you more data for your CIP and future monitoring efforts. This includes things like, how about the dates the customer representative signed the attestation? Otherwise, how are you going to know as of what date the information is current? Each owner's percentage owned or controlled would be good to know as well to make sure they've done the math right. It's also helpful to know each individual's title so you understand who these individuals are and just how far removed they are from day-to-day operations of the business. And last, getting an organization chart is especially helpful when there are intermediary entities between the customer and the ultimate human owners. Earlier in the presentation, I introduced the approach of having the customer self-identify its own legal entity type. So let's expand on that now. This is actually a practice that's been adopted by a number of financial institutions, including the one that I worked for. And essentially, how it worked was we included at the beginning of our beneficial ownership form a complete list of every legal entity type listed in the CDD rule, both the included types and the exempt types. The person completing the form is asked to check the box indicating the customer's legal entity type. Each category was numbered, and we listed the most common included types first. Then we listed below that all of the exempt types. At the end of the list, we had a statement saying, if you checked category, say 12 through 20, you need not complete any additional sections of the form. Simply sign and date below and return the form to us. This approach has many advantages. First and foremost, it simplifies the onboarding process because every business customer gets a form no matter what. Even the most obviously exempt types, such as sole proprietorships, still get the form. Along with this, it provides a clear audit trail. Every commercial customer should have this form on file for every new account they open. It takes away the guesswork as to which customer should complete a form. This simplifies your staff procedures and training, and it removes the risk of error in misidentifying a customer as exempt. And it also can provide more data for due diligence, monitoring, and analytics when you know for sure the exact type of entity that you're dealing with. In continuing our discussion here about the beneficial ownership form, it's important not to overlook the form instructions you provide to the customer along with it. In my opinion, the form's instructions are critical. Well-written instructions will help ensure the client completes the form accurately and minimizes confusion as much as possible. In your form instructions, include things like the reason why this form is required. Even a year out now from final implementation of the CDD rule, many new business customers or even longtime customers who are adding a new account may not have heard about this, and they might balk at completing it unless they understand that it is a federal requirement. You want to keep your instructions clear, concise, and simple, the Fisher-Price version, if you will. Include a basic beneficial ownership calculation example in your instructions as well. I found that this was especially helpful to customers in understanding that concept of indirect ownership. And finally, a number that someone can call for assistance in completing the form. A discussion of the beneficial ownership form wouldn't be complete without an evaluation of the various formats available. So let's take a look at each of these quickly. First, we have paper, which is the simplest. You can include it with your other onboarding documents, especially if you're using the approach we just talked about, where every client gets one. You also get a wet signature from the person completing the form, and it can be securely returned by mail or simply delivered in person. The main disadvantage to the paper form is storing it. Whether you store it in its original form or do you manually scan it for electronic record storage. The next step up is an electronic form provided by email. This gives you expediency and tracking capability. And we're talking here about a fillable PDF or Word form. It's easier for most customers to complete because it can be filled out on the computer rather than by hand. And the financial institution can monitor distribution, return, and follow up electronically by email if it's not returned timely. Now, this format is really the most effective if you're using e-signature, DocuSign, for example. If you don't have e-signature capability, you're probably better off with the paper form, because otherwise the client has to complete the form on the computer, print it, sign it manually, rescan it, upload it, and email it back to you. Or what's going to happen is you're going to get a lot of unsigned forms returned. Now, this form also does create a potential security risk if your customers are not using a secure encrypted email system for returning the form. This is because the form has personal identifiable information, or PII, on it relating to the beneficial owners. Using a secure online form is really the best in class way to go, and I think more and more financial institutions will be moving to this method. It's certainly most efficient for both the customer and the institution. And when it's designed properly, this format gives you all the benefits of an electronic form without the email security risk. You can also build in automated data collection, where the information that's input on the online form can be uploaded to your CRM system and your AML monitoring system, so you can analyze and query this data. Of course, the one disadvantage is that it does require a technology investment, but in my opinion, it is definitely money well spent. So moving on now from the subject to the form, let's talk about what we do with the information once it's returned by the customer. The CDD rule says that we must apply at a minimum the same customer identification processes for beneficial owners as we do for direct individual account owners. Just to review quickly, this means using one of two methods. The documentary method is most common and involves examining the individual's unexpired government-issued photo identification, evidencing nationality or residence. This is typically a passport, a driver's license, state-issued ID, etc. The one key difference with beneficial owners is that we can, fortunately, rely on photocopies or images of identification documents if they're not present at account opening. But you'll want to consider how to securely transmit and store these image documents. Now, the CIP rule doesn't require that we retain the image of a document we've reviewed, although it doesn't forbid it either. Just that we record that the review took place and what the type of document was that we actually looked at. If you're not going to save the ID image files, you'll want to use something like a CIP checklist or an attestation form completed by a staff member. Have them record the document and all the key information on it before destroying the image. Non-documentary methods are the fallback if we don't have documentary methods to verify identity. This includes direct contact with the individual, other external sources, tax returns, etc. Most likely, you'll rarely ever encounter the need for this, but be sure your procedures do describe how you're going to address it if a beneficial owner can't supply a standard identification document. And of course, OFAC screening in the United States of beneficial owner names is part of CIP as well, just as with new direct account owner names. How do the CIP rules then apply when you have one person who's a beneficial owner on multiple accounts? You might encounter this under one of two likely scenarios. Either the same legal entity customer is opening an additional account, or an individual is a beneficial owner of more than one legal entity customer, each of which has accounts, and one of these entities is opening a new account. For example, Bob Smith let's say, has an account at your bank for each of the two LLCs that he owns, Bob's Trucking and Heartland Farm Supply. He's recently formed a new LLC, Bob's Bait and Tackle. He's diversifying, and he wants to open an account for this new business. You already have CIP on file for Bob as the beneficial owner of his existing LLCs. Do you have to perform CIP on Bob again for this new account? Well, the CDD final rule says that the financial institution must identify and verify the identity of each beneficial owner of a legal entity customer at the time each new account is opened. Well, that's just fine, but it's not especially helpful in this situation. Now, you will have to obtain a beneficial ownership certification for Bob's Bait and Tackle. That's a given. But do you need to see Bob's identity document again since you already have it? Because this was one of the many gray areas in the final rule, FinCEN published supplementary guidance stating that we can rely on existing CIP documentation already on file if the existing information is current and accurate. For example, a driver's license is not expired, and a customer's representative attests to the accuracy of the CIP information that you have on file. How you store CIP documentation is critical here, just as we described previously. If you didn't keep a copy of Bob's ID, you should have recorded its expiration date in your CIP record so that you could check it and see if you need to request an updated one. Now, some important considerations here. The beneficial ownership record for the new account should clearly cross-reference the CIP records if you're not going to simply duplicate the record under the new account. And you need to get the customer representative's attestation that the information is current in writing, not verbally, and store this with each beneficial owner's CIP record. Although the rule says that you can get this information verbally, there's no documentation or audit trail unless you record the conversation, so just get it in writing. While an official form for this purpose is certainly a nice practice, even an email would suffice as long as you retain that on file. Now, I'd like to take a moment to talk about this particular aspect of the CDD rule, which is one of the most contentious by far, and that is, should a certificate of deposit or a loan that automatically renews or rolls over be considered a new account every time it renews? In FinCEN's first FAQ publication after implementation was final in April of 2018, they stood their ground with the wording of the final rule on this issue. They said, each time a loan is renewed or a certificate of deposit is rolled over, the bank establishes another formal banking relationship and a new account is established. Well, undoubtedly there was continued pushback on this issue because on May 16th, FinCEN issued a 90-day temporary limited relief on beneficial ownership requirements for rollovers and renewals. Basically, FinCEN was saying, okay, let us think about it and get back to you. On August 8th, which is when the first temporary order expired, FinCEN said, well, we need some more time to think about it, and they granted another 30-day extension on the temporary relief order. Finally, on September 7th of 2018, FinCEN said, okay, guys, you win, and the exemption for rollovers and renewals became permanent. So based on this exemption, the following are no longer considered new accounts. When a certificate of deposit automatically renews, when a loan renews, is modified or extended without underwriting review or approval, and the same for a commercial line of credit or credit card, and lastly, a safe deposit box rental renewal. Now note that this applies only to the rollover. the modification or renewal or extension of any of these accounts. You will still need to obtain a beneficial ownership certification when the account is first opened. I also want to touch briefly on performing CIP on a legal entity, some best practices and some red flags to be on the lookout for. This is going to become more and more important. As I said before, I believe we're going to see a ramp up in legal entity formations, mostly LLCs, in the coming years due to the 2017 lowering of the corporate tax rate. First of all, remember that the legal entity is the account owner or borrower, not the individuals who own or control it. The CIP rules require us to verify the identity of the account owner, but the rules are very slanted towards identifying individual account owners. So how do we verify the identity of a legal entity? Unlike a person for whom we can simply look at a driver's license or passport, for a legal entity, we should be looking for several forms of documentation that support its existence as a bona fide enterprise. You want to start with company formation documents, which are what describes and records the existence of the entity. For an LLC, it's articles of the organization, and an operating agreement. For a corporation or cooperative, it's articles of incorporation. Partnerships have a partnership agreement, and trusts have a certificate of trust or articles of trust. Next, Secretary of State registration in good standing is another form of evidence. However, keep in mind that good standing typically only means they've paid their annual fees and filed their reports. It doesn't have anything to do with whether they actually operate as a real business. Also, in some states, certain types of entities aren't even required to register with the Secretary of State. General partnerships are one type that don't in a number of states. Bylaws, minutes of meetings of directors or members or shareholders are further evidence that this is an ongoing enterprise, as are federal income tax returns and employer ID number or EIN registration or supplying a W-9. This is more a form of exclusionary evidence. If the legal entity doesn't have its own tax ID, there ought to be a good reason why. Disregarded entities for tax purposes are one reason, but they should disclose this to you on a W-9. Now some red flags to be alert for. No written formation documents. This is a big one. The entity doesn't really exist without a legal agreement or contract that has established its existence. Unsigned or out-of-date documents, canned or templated documents with no real substance, almost like something they just found on the internet and copied. And anytime the ownership information in a formation document doesn't match the beneficial ownership details they've supplied. This could simply be that they've never gone back and updated their documents, or something else might be going on here that merits further questions. So for our final topic today, I want to talk about the concept of reasonable belief in identity verification. The CIP and the CDD rules both state that a financial institution must establish a reasonable belief that it knows the true identity of both the legal entity customer and its beneficial owners. You'll want to be sure that you've established a clear and specific definition of reasonable belief and incorporate this into your policies and procedures, such as what will you consider to be acceptable forms of identity documentation for both a legal entity and an individual, when or if you'll allow your customer to start using a new account while identity verification is still pending. In my mind, this isn't really a good practice, but I suppose institutions may do this when it's commercially necessary. Also, what are you going to consider to be unacceptable identification, resulting in your refusal to open the account? And finally, when to file a suspicious activity report, or SAR, based on CIP or CDD rule issues. And I'll share an example with you of an issue that I encountered when performing CIP on a beneficial owner of a new commercial borrower that was domiciled and operating in the US. This beneficial owner had a 50% indirect share of the business, which was actually hidden under several layers of holding companies. We received a copy of his Canadian passport, which did verify his identity for CIP purposes. However, his residence address supplied was in the US. I followed up with a request for his permanent residence address in Canada and was then told, well, he has no such residence and he's been living in the US full-time for the past 10 years or so. And this is all coming through a representative of the company that's issuing the loan. Tax ID number that was provided for him was a Canadian Social Insurance Number, or SIN. And now we did make the loan to the company, but I was suspicious of whether he could really be here in the US legally. So I reached out to a contact I had at Homeland Security, asking them if a SAR would be warranted here. And interestingly, I was told emphatically yes, and please let us know once you've filed so we can begin pursuing this matter. Now, I don't know what ultimately transpired in this case, but it's an example of how much we as compliance professionals can help law enforcement do their jobs, which is really our ultimate objective with anti-money laundering and collecting beneficial ownership information. So let's recap the key takeaways from today's presentation. First of all, I urge you to have your customer self-identify their legal entity type. This may save you a great deal of hassle procedurally, give you an audit trail, and minimize your compliance risk. Be sure your staff understand the two prongs of beneficial ownership, the ownership prong and the control prong, and that while a legal entity may not have anyone under the ownership prong, they must still name a person under the control prong. Check the customer's math in calculating beneficial ownership and challenge anything potential miscalculation. Require the customer to identify its beneficial owners. Don't do it for them. And document all your policies, procedures, and practices. Especially describe your rationale when addressing risk-based decisions or when you've interpreted a gray area that is involved in your decision. So now I'm going to turn it back over.
First of all, I'd like to thank everyone for joining today's webcast. We are running a part 2 of this webinar on May 16th. And during that webinar, we're going to be covering part 2 of this topic, where we'll talk about storing, managing, and maintaining beneficial ownership data, the opportunities for enhanced transaction monitoring and customer risk assessment from your beneficial ownership data, and how good documentation is the key to regulatory compliance. So please do join us. So before we sign off, I'd like, on behalf of CaseWhere RCM and Refinitiv, I'd like to thank Lori for today's presentation and our participants who weathered through the technology issues and still managed to attend today's event. We hope that you did find it useful, and that if you have any other questions, please do contact us via email or visit our website. On behalf of myself and the team at CaseWhere RCM, we wish you a great day. Thank you very much.